All right, so we are off to a positive start for stocks right now. The TSX, a 30-point advance to begin the trading day, up about 0.2%. The S&P is also higher right now, but still some big questions on the road ahead from here. Let's bring in Dennis Mitchell. He's CEO and Chief Investment Officer at Starlight Capital for his take on the markets. Dennis, nice to see you. And what's your general take on the state of affairs in the world of investing right now?
Well, I mean, it's been pretty volatile, right? It's been an interesting ride for most investors. I think the key for us right now is interest rates and inflation have driven volatility in markets this year. We think the Bank of Canada is done hiking rates. We think that the Fed might have 25 basis points left in November. And then we think next year, the Bank of Canada will probably be forced to start cutting rates as early as May or June of next year. I think the Fed is probably on the sidelines next year. It is a U.S. presidential election. Their economy is slightly less interest rate sensitive. But I think in 2025, you'll see the Fed come back into the market and start cutting rates.
Okay, let's come back to that call on the Bank of Canada. And just a reminder for our audience that the Canadian Central Bank has its next interest rate decision tomorrow. And it's hard to find economists on Bay Street who would anticipate a move higher in rates from now. Why is it, do you think, at this point, though, that they are done with this rate hike cycle?
Well, it takes anywhere from 12 to 16 months for rate hikes to impact the economy from an operational standpoint. When you start hiking rates, the first impact is on discount rates and valuations, and we've clearly seen that in the markets. I mean, Canadian REITs are trading at a 28% discount to net asset value, and utilities are not far behind. The second impact is operational. When you start refinancing debt, you start paying more to service that debt, and that puts downward pressure on free cash flow, which then has a secondary negative impact on valuations and returns. So if you expand that out into the economy, households are going to have less disposable income. That's going to impact their ability to consume, and GDP growth will probably come down. So we think the Bank of Canada is done. They'll let the last 200 basis points of rate hikes start to filter through the system and impact the economy. And the last inflation print we had was pretty benign. So we think the Bank of Canada is done and on the sidelines.
You alluded to the idea that we could see rate cuts at some point moving into next year. What's the determining factor on that? Do you have to see a notable contraction in the economy? Do you have to see more progress made on inflation? What are you going to be watching for?
Well, the Bank of Canada's mandate is specifically price stability, and that translates into inflation. So if inflation's down significantly from its peaks earlier this year and last year, I think the Bank of Canada has some time to kind of look at the trajectory and the trend and ascertain whether the last 200 basis points when they impact the economy are going to bring inflation down to 2%. But I think looking into 24, 25, we have significant waves of mortgage refinancing that are going to take place. In 24 and 25, you're going to see significant waves of fixed rate mortgages refinance, and that'll put downward pressure on household consumption. And in 25 and 26, you'll see significant waves of variable rate debt, and those will also put downward pressure on household disposable income and consumption. And 60 to 70% of the Canadian economy is domestic consumption. So as that goes, so goes our economy, GDP growth, and of course inflation. So I think those will be the main drivers that force the Bank of Canada to start cutting rates. If not May and June of next year, then certainly by Q3.
So we'll watch to see what happens on the rate front. All of this focus on rates has influenced the markets, broadly speaking. You're one of our go-to guests to talk about investing in publicly traded real estate entities. And that subgroup for the TSX has seen overall a double-digit percentage decline this year. How are you going to look at that group? Because certainly, we hear from a lot of guests about pockets of the Canadian stock market that are undervalued. What's your general view on investing in the real estate sector right now?
You definitely have to be a stock picker, right? There are a couple of sectors like residential, industrial, cell towers, data centers, where you've got abnormal growth. And so that's what you're going to need. There's the old saying, whatever is scarce becomes dear. Well, going forward next year and the year after, what is going to be scarce is growth. So inevitably, you're going to be looking for companies that have the ability to grow their cash flows faster than the average and more resiliently than the market as a whole. And so we like residential and industrial, cell towers and data centers for that very reason. I think you're going to nail me down on a name shortly, aren't you, John?
Well, it always helps. It always helps if there's a good example of that, yeah.
Well, look, Granite REIT is going to be reporting shortly. We like them. They're an industrial REIT. Vacancy across the industrial market in Canada and North America and Europe is low single digits. In North America, it's 3% or less. There isn't a ton of new supply coming into Granite's markets to disrupt that. They've got a very attractive balance sheet. I'm just looking at our model as we speak. We have them trading at a 25% discount to net asset value, which is a significant discount to the 0 to 5% premium that it historically trades at. A loan to value of 33%, so significantly below where I think most investors think the real estate market is. And we expect them to generate 6.5% FFO and AFFO per unit growth going into 2024. So it's hard to argue against a name that is yielding you a decent, where am I on the yield?
I think I saw it around 4.8.
Yeah, so it's hard to argue against a name that's yielding you almost 5%, that's generating 6.5% growth and trading at 25% discount to NAV with structural drivers powering the fundamental outlook. So that's a name we like. It's in our top 10.
Sorry to interrupt you. We're almost out of time, but I just want to compare that to the yields in the bond market. Everybody keeps talking about that, and a lot of people say that because of the yields that these government bonds offer right now, that can give investors patience on maybe some of the discounted names in the stock market that tend to have higher dividend yields. What would be your take on that?
Yeah, and I can see how that would be appealing in a volatile market. The 10-year bond yields at 4%. You can get bank GICs at 5%. But what I would say is that's interest income, so it's going to be taxed at your highest marginal tax rate. If you're getting, first off, a higher absolute yield from a REIT like Granite, most of their distribution, or a good chunk of it, will be return of capital, which is not taxed when the investor receives it. So when you look at after-tax yields, you're going to be far better off in the REITs. And the REITs themselves are actually growing their cash flows. If I look at our fund, we've had, I think, 19 distribution increases this year, and the average increase has been over 10%. You won't get that type of yield growth out of a GIC or out of a bond.
Okay.